Okay, good evening, everyone. Welcome to our class. Can you please confirm you can hear me before we start? Somebody should please confirm that you can hear so we can continue with the class. Okay, thank you very much. Thank you very much. The last time we met, we need to start right away while we wait for our other colleagues to join us. The last time we met, we discussed IAS38, intangible assets. So we were able to look at the accounting issue around those assets or the standard. Okay, and today I will go straight to IAS37. I hope I will be able to touch on IAS8 accounting policy, and in case the examiner decides to, pick us up on this particular standard. Okay, so IAS37 deals with deals with provisions, contingent liabilities, and contingent assets. Okay, and what are the real issue around this standard? Okay, now, so I'm going to start straight up. Just relax and just put me on loudspeaker and listen. Okay, so I'll try to give you so many information around the standard. Then we'll take a look at a couple of questions and we'll see how we can handle it. Okay, now, so we are looking at three things: provisions, contingent liabilities, and contingent assets. Okay. Now, when you talk about provisions, you are trying to provide for. For example, I can provide for bad debts. I can provide for, for example, if you are going to the market, you want to buy stuff, you can say miscellaneous because you're not really too sure whether you will need additional fund, okay, to do that amount. But when you come to accounting, entities can use provisions to manipulate the accounts. Okay, what does that mean? In accounting, we have something we call big bat accounting to say that in the year that a company is making a lot of profit, they can create provision. When you create provision, you debit the P&L and credit provisions within your liability so that it reduces your profit for that particular year. And in the year that you are now making losses, you can now reverse or release those provisions back into the statement of performance. Okay. So because of those issues, we now have a standard that governs provisioning in the financial statement. Okay. So what is provision? Provision is a liability of uncertain timing or amount. Is a liability. I remember we've discussed liability to say it's a present obligation as a result of past events to require an outflow of resources or embodying economic benefits to settle that particular liability. Okay, so provision has to be a liability. So everybody understand what liability is all about. But I'm not certain about the timing. When am I going to pay? I don't know. Then the amount. If I'm certain about the amount, and I know it's a liability, obviously I recognize payables or liability straight up, but I don't know. Okay, so that's why I need to provide for. So that's why it's defined as a liability of uncertain timing or amount. We need to understand that. Now, I've tried to lay some background, so I won't waste time because we needed to complete the standard, and probably I can introduce you to IAS8 accounting policies. Okay, now, so let me go to recognition criteria. Before an entity can recognize provisions, three conditions must be met. The examiner will try to play around those preconditions, gives you scenario questions, then you are battling with it to see whether you can actually create provisioning. Three conditions must be met. Number one, there must be present obligation, legal or constructive, as a result of past events, obligating events. Two, an outflow of resources will be required to settle the obligation. And three, the amount of obligation can be measured reliably. It's so simple and so sweet the way I have said it, but if you see some questions, then it becomes a problem. Why? Because you have not understood what I've just said. So let me now explain. Sorry, I'm not showing you on the slide. Let me try to locate it. Okay, I've seen it. You know, I don't really like looking at the slide when I lecture. Okay, so let me pick it one after the other and explain. We said before provisions can recognize, three of those conditions must be met, not two, not one. All the three must be met. No, I already told you one of the problems around provisioning. You can use it for creative accounting, manipulate your account. Okay, now there must be present obligation, legal or constructive. What does that mean? If I have a future obligation, I cannot create provision. I cannot. It has to be present obligation that arise as a result of contracts, legal or by law, okay, or by constructive obligation. What is the meaning of constructive obligation? Say, for example, if you go to, let's say, let me use an example. Let's say Samsung Office or any of these electronic brands, you know, around, and you buy, let's say, okay, let me use Thermocool. You buy a Thermocool deep freezer from that office, and after 3 months, you take it back to them. Maybe there's a fault around the freezer, and they repair it for you for free. Then you take it back home. Okay, even though it's not written anywhere, or probably it's under warranty. Okay, now, and they have been doing it over the years. That is what that means is they have created a constructive obligation. So constructive obligation means it is a past pattern of practice of an entity, what they have been doing. Sometimes it might be published on their website. Is that okay? So that's what I mean by constructive obligation. So if I have a present obligation, which could be legal or constructive, and it has to be as a result of past events, what does that mean? That is obligating event. Listen to me here. Just be with me. Like I would say, put me on loudspeaker and listen. What does that mean? Obligating event gives a condition to a company that they don't have any realistic alternative than to settle the obligation. Does that make sense? If I can avoid that obligation, I cannot make provisions. You need to understand that. And that's what I'm building on. If you understand this, I will not struggle in every other stuff we're going to look at. If I can avoid the obligation, I cannot make provision. That's the meaning of obligating event. Let me give you a classical scenario. So let's say, for example, at your work, you are the accountant, and in your policy, you have to repair your air conditioning every 6 months. You must repair. Whether they have fault or not, it doesn't matter. It's a regular maintenance that you do every 6 months. Then you are preparing your company's account in December. Let's say December 2020. Is that okay? You're already preparing an account. Then you are now thinking, can I make provisions for these repairs that will be carried out in June 2021, because you are preparing an account of 2020? Can I make provision? Because it's certain that once we get into June 2021, we are going to repair. Okay, it's in the policy. And that's what you have been doing over the years. Can I make provision for that repair? The answer is no. You cannot make provision. Do you know why? You can avoid that obligation before that time. You can decide to sell those assets before that time. Therefore, you do not have any obligating event. You need to understand that, because the examiner will play a scenario to you and you'll be tempted to say provisions can be recognized. You need to check that the entity, do you have present obligation, which can be legal or constructive as a result of past events, obligating events, once I can avoid it. In fact, even if it is required by the law, but you can avoid, you cannot make provision. It has to be as a result of past events, and it has to be obligating events. So you need to understand that. So if you understand that, I will now take you 5 things under provisioning, 5 of them: future repairs to assets, future operating losses, onerous contracts, environmental provision, and restructuring provision. And we have ended IAS37. But before we do those 5, let me tell you measurement criteria. Then I go to contingent liabilities and contingent assets. Then I come back to that 5. Then we say bye-bye to IAS37. So successfully, we have defined what provision is. I was able to tell you the background, why IAS37 was issued, because provisions can be used to manipulate reported accounts. And of course, we take a look at the recognition criteria. And I told you that those 3 conditions has to be met. Number 1 is there has to be present obligation, legal or constructive as a result of past event, obligating event, and it must be probable that an outflow of resources, cash, will be required to settle the obligation, and the amount of obligation can be measured with reliability. So let me now go to measurement criteria. Measurement criteria. Measurement criteria. Okay. When I have already met those conditions, how can I measure my provisions? So you need to be with me here. How can I measure my provisions? How can I measure my provisions? According to IAS37, okay, provision is measured at the best estimate of the expenditure required to settle the obligation. Can I say that again? Oh, sorry. It's not still on the screen. I just provision is measured, sorry. Provision is measured at the best estimate of the expenditure required to settle the obligation. For a single obligation, for example, court case, you are going to estimate the most likely amount payable, okay? And for a large population of items, for example, warranty provisioning, you look at what we call the expected value. So you need to put that in your head, especially ACCA student, because most likely if you see a scenario and you need to respond to the examiner, you are going to explain the principle. Is that okay? You are going to explain the principle. I'm going to take about 1 hour in our class next week. I'm not sure of the date yet. I'll tell you what is coming up in number 1, what I'm going to say number 1, the likely area number 1, and then number 2, then the other questions, okay? I'm going to pick you up on that and how to deal with those scenarios, okay? So anytime you are dealing with scenarios, in fact, the examiner says that they have limited marks for computation. You know, in the last 2 years, I've been telling ICANN candidates that a time is coming. You'll be able to count the number of times you press calculator in the exam. ACCA is there already, okay? They are there already. You count that number of times. In fact, at some point, your calculator will be useless. You are dealing with scenario and you're explaining the principle to the examiner and you are relating it to the scenario. Is that okay? So I'm still going to teach you, although as I'm teaching, I'm already telling you all those exam techniques, okay? So you might require that you have a scenario and it's asked you to respond. Most likely, in the requirement, nobody will tell you they are testing IAS37 provisions. You need to understand the standard and be able to depict or detect that this is IAS37. If they are battling with measurement, probably they have done it in a way that you need to respond by stating the principle under IAS37 to tell the examiner to say, under IAS37, provisions are measured at the present value of the expenditure required to settle the obligation, okay? Now, for a single obligation, for example, court case, you estimate the most likely amount payable. And for a large population of items, for example, warranty provision, you look at the expected value. IAS37 now says if it is material, they are discounted to present value. Most likely the examiner, if he wants you to do the computation side, he will give you the percentage. So you discount to present value. So that is how it is measured. Can you see? So I've explained all of this, okay? So let's just look at this short question to demonstrate what we have said. Now, in the requirements, it says calculate the warranty provision required. Here, he already told me that I have to make provision. So I might not really struggle, whether I'm to make provision or not, because it says calculate. But how will I even know that I'm supposed to make provision? So you can also find out by checking out those 3 recognition criteria. So let's take a look. It's a very simple question. I just want to use it to demonstrate what we have done. Clean sells domestic appliances such as washing machines. On 31st December, Clean decided to start selling washing machines with a warranty. Under the term of the warranty, Clean will repair washing machines at no charge to the customer if they break within the warranty period. The entity estimates, based on past correspondence with customer, that 20% of the washing machines sold will require repair. They have sold it, okay? That's past event within the warranty period at an average cost to Clean at $50 per machine. Clean sold, did they say past event? It did not say Clean will sell. If they are going to sell, you cannot make provision. So it's already past event, okay? Legal or constructive. This is legal obligation because they already have a warranty, okay? That's legal, okay? Now, will an outflow of resources be required to settle this obligation? The answer is yes. Can it be measured with liability? The answer is yes. So what do? How many did I sell? I sold 200 washing, machines. How many am I expecting that will be returned? How many will be returned? It says 20%. Remember, it's an estimate, okay? So that's why provision is defined as the liability of uncertain timing or amount. Is that okay? So I sold 20%. I sold 200. I expect 20% of that 200 to be returned. So if 20% is returned, how much will I use to repair? It says $50. I multiply. That's all. So whatever amount I get would be my provision. So after doing that, you have 2,000. Like I said, I just want to show you how provision is being made. Okay. So that's it. And if your provision is no longer required, what do? You recognize. Then subsequently, you are going to increase, since you have discounted to present value, the finance element, you unwind, you take it to, I think I took you that on IAS16, if I remember. You take that to, POL, finance cost, and credit the kind amount of provision in your account. I've also explained provisions and creative accounting when I mentioned big bat accounting, that in the years that companies are making profit, they can create provision to reduce the profit. And in the year that they are now making losses, they now start to release those provisions to appear as if they're actually performing. So that's why we have IAS37 around that, okay? And if those 3 conditions are not met, you cannot create provision. So let me quickly take you on contingent liabilities and contingent assets. They are very simple. There's no computation here. Then I go back to those 5 issues that I mentioned earlier, okay? Now, what's contingent liability? From that word contingent, is dependent on an event or on a condition. That's it. So a contingent liability is a possible liability, okay? Or you call it possible obligation, arising as a result of past events whose existence will be confirmed by one or more uncertain future events which are not within the control of an entity. For example, you have a court case. You don't really know whether maybe one of your clients has sued your company. You don't know the outcome, whether you are paying or not. Okay, that is why it's a contingent liability, because the outcome of that court case will let us know whether we don't know the outcome of the case. It's uncertain, so we don't really know. In fact, maybe they just nearly sued you. You cannot even estimate. You don't have an idea. You're just trying to consult your lawyer and all of that. So it's a contingent liability. Warranty provisions might also be an example in some cases. Okay, then income tax disputes, financial guarantee given. So you have so many examples around contingent liabilities. Now the question is this: can I recognize contingent liability? The answer is no. You cannot recognize. Okay, if it is remote, you ignore contingent liability. If it is remote, you have to ignore, you don't recognize. If it is possible, you can disclose. Okay, if it is possible, you can disclose. And if contingent liability is probable, okay, it is probable. That means it's already getting to liability. So depending on the condition, you can decide to disclose or you provide for. Is that okay? But generally, contingent liabilities are not recognized on the financial statement. At best, what you can do is to disclose. Is that okay? So you check 3 things. Is it remote? If it's remote, you ignore. Okay, that means the probability of it occurring is so low. Okay, that's remote. Then if it is possible, 50%, it is possible, you can disclose. Then if it is probable, more than 90% that's going to crystallize, is already becoming a normal liability. So you can provide or you disclose. Is that okay? All right, so that's that, contingent liabilities. Let me go straight to contingent assets. It is a possible asset, okay, as a result of past events whose existence will be confirmed by one or more uncertain future events. So why is it an asset? For example, I sued another company, or I sued one of my customers for defamation of character or for negligence or whatever. Okay, so I'm expecting that I'll be compensated. That is an asset. Cash is coming in, okay, or whatever, maybe in Bitcoin or whatever. Okay, so I'm expecting an income, but I'm not really quite sure. Okay, so that's why it's not an asset. It is a contingent asset because to be dependent on one or more uncertain future events which are not within my control. So it makes it a contingent asset. So what's the accounting treatment? If it is remote, you ignore. If a contingent asset is remote, you ignore. Okay. If it is possible, you ignore. You ignore. Okay. You also ignore if it is possible, and if it is probable, you can decide to disclose. Okay. If it is probable, you can disclose. But once it becomes a normal asset, for example, you have received the cash, then you can take it straight as your asset. Is that okay? So that's what you need to learn around contingent liabilities and of course, contingent assets. Okay, so let me go to the special situation. You know, I mentioned that there are 5. So I'm going to explain them, then we'll be seeing some questions along the line. So after explanation, then we can move away from here. 5 things: future operating losses, onerous contracts, future repairs to assets, environmental provision, restructuring. For ACCA exams, they like restructuring. Okay, then probably environmental provision. Let's find out. Future operating losses. What does that mean? I have a business and I'm anticipating that this business is going to start making losses. Say, for example, because of COVID-19, shutdown, lockdown, and all of that. So this business, I'm anticipating that it will start making losses, or probably there's a government policy that places ban on importation of certain products that I've already purchased, and that product all of a sudden become contraband in the country, then is lost. So I'm already anticipating that future losses is going to occur. So the question is, can I make provision for the loss? The answer is no, I cannot make provision. Do you know why? The loss relates to the future. Is that okay? It relates to the future. Remember we said there must be present obligation. legal, or constructive as a result of past events, obligating events. I spent time explaining that. So if I have a business that I'm anticipating to be loss-making, I cannot create provision because it relates to the future, and I can even avoid the loss before it happens by selling off the business. Okay. In fact, as a matter of fact, an expectation of future operating losses might be an indication of impairment. Okay. As such, you might need to apply IAS36. That's that. So I'm sure you understand that, right? So let's go to number 2. Let's go to number 2, onerous contract. Onerous. At least you understand what I'm saying. Oh my God. So what's the meaning of onerous contract? Okay. Now, onerous contract are those contracts whose unavoidable cost of fulfilling the contract exceed the economic benefits from those contracts. Is that okay? Unavoidable. I need to incur that cost, but it's higher than the benefits I'm deriving from that. So that's what they call onerous contract. So it's almost, or it's normally happen around lease arrangement. So for example, I have leased a warehouse for 5 years, for example, and I'm paying every year. Let's say I pay 200,000 every year. Year 1, 200, year 2, 200,000, and all of that. All of a sudden, lockdown or shutdown or whatever happened, okay, or whatever events in the economy, or the products I import that is stored in the warehouse is no longer available. So whether I like it or not, I needed to pay. Let's say I'm in the 3rd year or the 2nd year, I needed to pay for the remaining years. So the unavoidable cost, say, let's say I'm in the 2nd year, I say I have 3 more years to go. That's 600,000. Is that okay? Okay. And the benefits I'm going to derive is lower than the unavoidable cost. So that is onerous contract. Is that okay? So since the cost is higher than the benefit, then that's onerous contract. Can I make provision? The answer is yes. The examiner says, or the standard says, that's it, the examiner. The standard says you can actually make provision, okay? And in making that provision, it's has to be the lower of the cost of fulfilling the contract and the cost of terminating the contract. Is that okay? The cost of fulfilling. That's the fulfilling is, I still need to pay 3 more years, 600,000. Then what is the cost if I terminate now? That means I don't want to pay, okay? And penalties. So the lower of the two will be the measurement of my provisions. Is that okay? So this is, I think this is what I was trying to explain. So the provision is now measured at the lower of the cost of filling the contract and cost of terminating the contract plus any penalty. So that's what you are doing. Now, so before you look at the question, let's look at future repairs to assets. I think I mentioned that when I was explaining the recognition criteria earlier. I need to repair an asset in the future. I've been doing it, okay? Can I make provision? The answer is no. It relates to the future. I can decide to sell before, even I may not sell actually. But you know, in accounting, you have what we call prudency concept. Okay, so you need to be prudent. So I can decide to sell before that time. So once I can avoid it, I don't have obligating event, I cannot make provision. Exercise 2. Exercise 2. Danboy is a company that owns several shops, which has a year end of 31st December 2021. One of the shops is loss making. Did you see that? Loss making. At 31st December 2021, Danboy forecast that this shop will make a loss of $50,000 in the year ended 31st December 2022. In the requirement, it says discuss the accounting treatment of the above in the financial statement. On 31st December 2021, Danboy closed down a different shop, which is different from this one. Okay. At that date, there were still 3 years left to run the shop lease. lease rentals are 100 per annum, the landlord will allow that boy to cancel. So when I come here, this is talking about future operating losses. Okay, if it is future operating losses, I cannot make provision because I can decide to I can decide to close down the business before that time. Okay, now even though here it says one of the shop is loss making, it's already making loss. We now forecast again that the shop will make, can you see, future operating losses of 50,000. So what will be the accounting treatment? They cannot, it will continue, they can't make provision for this. Then for this other one, let's take a look. It said we have 3 years left. Okay, 3 years left to run the shop lease, and the lease rental is 100 per year. So that means I have 300,000. Okay, then the landlord will allow me to cancel if I can pay one of you of 200. So which one is the lower? Okay, that's onerous contract, right? Now I told you it always happens in lease arrangement. Okay, so the lower of the two, I can measure that and provide, so which is 200,000. How do I get the 200,000? You know, we said for onerous contract, provision is measured at the lower of cost of fulfilling the contract. If I want to fulfill this contract, I pay 100,000 for 3 years, 300, and the cost of terminating the contract plus any penalty payment. So if I want to terminate, that's cancel, I pay this 200. So I can measure it, I can provide 200,000 for that. Okay, so you have the solution there, so you can take a look. Let me look at this question. An entity has a reporting date of 31st December 2027 and intends to repair an item of plant next year. The cost has been reliably estimated to be 10,000. The repair was made the following accounting period for 12,000. Okay, what provision, if any, should be recognized? Okay, can we make provision? Let's find out. They intend to repair an item of plant next year. Future repairs to assets. They can't make provision. Okay, they said so. Don't be trapped with what the examiner has said. He said the cost has been reliably estimated. They met one condition. You know, we said the third one is the amount of obligation can be measured reliably. We have only met one. What about the first one? There must be present obligation, legal or constructive, as a result of past event, obligation event. I can say this I said before that time. So I cannot provide. Okay. Okay, I cannot provide. Let's look at another question. Under the new legislation, an entity is required to fit smoke filters to its factory by December 2027. At the reporting date of 30th June, the entity has not fitted the smoke filters. Should a provision be made? Okay, by law, the law is requiring that this company should fit smoke filters into their factory by December. And when we are preparing our account as at 30th June, we have not done it. Can I make provision? The answer is no. I don't have obligating event. Even though it's required by the law, I cannot make provision. Do you know why? It relates to the future. I can stop or cease my business before that time. Remember, once you did not have obligating event, you need to learn that I can't make provision. So you just apply that principle. Okay. Now we have two more things to do: environmental provision and what's it called, restructuring provision. Please be with me here. The first three that we have done, they look so straightforward. When I see environmental provision or environmental issues, and it borders around whether I'm to make provision or not, what do I do? Okay. Now, when it comes to environmental provision, I can make provision, I may not make provision. It depends on the situation. But listen to me. What is the meaning of environmental provision? That is, for example, you are talking about clean-up costs, okay? Clean-up costs or cost of decontaminating and restoring a site. For example, you go to the oil rig, the chemical companies, the paint companies, you know, they do a lot of damage to the environment, okay? So, and they needed to incur some costs probably to repair or to do what we call cleanup of those environments. So the question is, can they make provision? Is that okay? The answer is yes, provided they have an obligation or they have created an obligation to repair the damage. Be with me here. I cannot make provision for damage that I will cause. Does that make sense? I know certainly that in the coming weeks or next month, I'm going to cause environmental damage. I can't make provision. I can only make provision if that damage has been caused. That should be as a result of past event. So a provision can be recognized if a past event has created an obligation to repair the damage. You need to understand that, okay? If I can only, that means if I have a scenario and I was told that they are certain that damage will be caused by the environment, okay, you can't make provision. Is that okay? So you can only make provision, or you can recognize provision if past events has created an obligation to repair. Even if I have been causing damage and have not been repairing. Is that okay? And there's a law that compels me to go and repair. I can create provision, because especially if the law we have retrospective effect, then I can create provision. Retrospective means all damages I've caused, I need to go back to those years and to those damage and repair. So please take notes. Okay, so sometimes an entity can also create a constructive obligation. Anytime they make damage, they repair, even though there's no law. So what they have been doing it. Remember, constructive obligation talks about past pattern of practice. Is that okay? So when you say a question on environmental provision, you need to check very well to be sure that it's not related to the future, and that's be around decontaminating the environment or cleanup costs. So let's take a look at this example or this question. He said, for each of the situation, explain whether a provision can be recognized. An entity has a policy of only carrying out work to rectify damage caused by the environment when it is required by the law to do so. So if the law has not told me, I will not do anything. For several years, the entity has been operating an overseas oil rig, which causes environmental damage. The country in which the oil rig is located has not had legislation in place that requested the damage to be rectified. A new government has recently been elected in the country. At the reporting date, it is virtually certain that legislation will be enacted and that will require damage rectification. This legislation will have retrospective effect. I have caused damage. A new government has come, and I was told that it is virtually certain, almost 100%, the new legislation will be enacted that will require me, or that will require rectification to damage, and it will have retrospective effect. Can I make provision? If this comes to play, can I avoid the obligation? The answer is no. I can't avoid it, and as such, I can create provision. Even if the business no longer exists, they will go and pull the shareholders. Come and repair, or the owners of the company. Is that okay? Now, under a license granted by a local government, an entity constructed a rock crushing plant processing material mined from the surrounding area. Mining activities have already started. Under the term of the license, they have started activity. Can you see that? They have started activity. Now said under the terms, the entity must remove. They must remove the rock crushing plant when mining activity has been completed and must landscape the mining area. They must remove. That means they have an obligation. They cannot avoid it. Okay, they already have a legal obligation. Okay, so that means they can create provision. They can create provision. That is it. So you have the answers there. I'll try to answer them for you. So let's look at the last aspect. Okay, restructuring provision. Nobody asks you what is restructuring, but I know you have heard the word restructuring before. Restructuring is a program that is planned and controlled by management and it will have material effect on the scope of a business, okay, or the manner in which that business is being undertaken. That's what they call restructuring. Okay, for example, they can eliminate some layers of management. They can do all sorts of things. They can relocate the head office from Lagos to Abuja. All those ones are restructuring. The question is this, or they can even close down a particular line of business or a product line. Those are restructuring. Can I make provision when it comes to restructuring? The answer is yes, provided two conditions are met. So you need to listen to me carefully. Then we look at the question, and at the end, we look at one more bigger question. Then I can say bye-bye to IAS37. Can I make provision for restructuring? The answer is yes, provided two conditions are met. If I meet one condition, I cannot create provision for restructuring. But if I have to meet the two before I can make provision, okay, can I make provision? Then I can. Now, number one, before I can make provision, there must be a detailed formal plan for the restructuring that identifies the business, the location, and the employees affected, as well as the estimate of the cost and the timing involved. Let me say that again. There must be a detailed formal plan for the restructuring. So if I want to carry out the restructuring, there must be a plan, okay, that identifies the business. Which business do I want to restructure? Or do I want to sell off? Or do I want to stop? Okay, where is the location? And the employee, you know, people are working there, and the employees affected, as well as an estimate of the cost. How much am I going to spend? And the timing involved. Okay, we're going to take 6 months, 1 year, 2 years, 3 years. That's what I'm doing. Number two, the employees affected must have a valid expectation that the restructuring will be carried out, either because the restructuring has started or they have been duly informed. Does that make sense? The employee affected must have a valid expectation that the restructuring will be carried out, either because the plan has been formally announced to them or because the restructuring has started. Do you know the point here? Remember, I told you the problems and provision. Okay, what it means is mere conducting board meeting that we are going to restructure is not sufficient. Even if you have a detailed formal plan for the restructuring, if you have not communicated it to the employees involved, or probably it has started, they are already seeing it, you cannot create provision. Okay, so you need to understand that. So that means a constructive obligation must exist at the reporting date. Okay, at the reporting date. If you now meet that condition after the reporting date, IAS37 will not apply again. Another standard will apply, if you can remember, IAS10, events after the reporting period. Okay. You can look at this question, right? To demonstrate what I've just said. After that question, sorry. Okay, after that question, I'll come and look at this question. So we can say bye-bye to 37. Then I take it straight to IAS8. I guess I think that should be the next stuff we are dealing with. Okay, so let's look at this question. Let me look at the requirements so that as I'm reading, I can be answering. For each of the two schemes, discuss whether a provision should be recognized, and if so, at what amount. Okay. On 15th January 20X5, the Board of Directors of SHIN voted to proceed on 2 reorganizational schemes. So that sounds like it's restructuring involving closure of 2 factories. Obviously, this is restructuring. Okay. SHIN's reporting date is 31st March. This is quite instructive. So most likely it's going to have impacts on our computation. Okay, and the financial statement will be authorized in June, 3 months after. Is that 3 months? Okay. All right. Now let's look at scheme 1. Sorry. Now the closure cost will amount to $125,000. The factory is rented on a short-term lease, and there will be no gain and losses arising on this property. The closure will be announced in June and will commence in August. Oh, really? The closure will be announced in June, and I'm in March. So it will be announced after the reporting period. They can't make provision. They can't. We said there must be a detailed formal plan. They said that. And number 2, the employee involved must have a valid expectation that the restructuring will be carried out, either because it has been formally announced to them or it has started. So we're going to announce in June, and that condition must be met at the reporting date. And I'm in March. Can I make provision? Obviously, no. I can't make provision. Is that okay? Okay. Because we're announcing, that's why I highlighted this, that this date is very important here. Then scheme 2. The costs will amount to 45 after crediting profit or loss on disposal. How are they crediting? They don't need to credit. Okay, they just do all the estimates. So it should be 150. Okay. Now the closure will take place in July. Okay. That's before signing the account. Oh, sorry. After authorizing the account, okay, and after signing the account, okay. But redundancy negotiation began with the staff in March. Oh, they met the criteria in March. Remember, the reporting date is 31st of March. So when I'm preparing my account, I can decide to make provision of 150,000. Is that okay? And that's it. Any question for me? Structuring is all about dates. Once you remember those 2 conditions, then you take a look at the date, whether they are met at the reporting date. No question. Brilliant. Okay, so let me look at one more big question. Okay, this is summary. I think this is what I was telling you earlier. If contingent liability is remote, you ignore it is possible to disclose, it is probable disclose or provide. If asset is remote, you ignore, then possible or probable, you can decide to disclose. Okay, let's look at this question. Let me look at the requirement. Is a draft a report suitable for presentation to the directors of market join? Show the accounting treatment for the above warranty provision under IAS37 for the year ended 30th October 2007. Okay, so let's see what they have in here. Market Joy is a public limited company and is a leading support service company which focuses on building industry. The company would like an advice on how to treat certain items under IAS37. Okay, warranty. The company manufactures and sells building equipment on which it gives standard 1-year warranty to all customers. Okay. Standard 1-year warranty. The company has extended the warranty to 2 years for certain major customers. Okay. So there's an extension for 2 years, but not all of them. Okay. Remember, all of the customers have standard warranty for 1 year. Then certain major customer has warranty for the second year, for 2 years. That means they have it in year 1, they also have it in year 2. So some of them were extended. Okay. Now I was trying to think on that, and as insured against the cost of the second year warranty. The warranty has been extended at new cost to the customer. So that means the customers are not paying anything. We have insured, so we are the one that will pay. Now, the claims made under the extended warranty are made in the first instance against Makajo. And the Makajo in turn make a counterclaim to the insurance. Past experience has shown that 80% of the building equipment will be subject to warranty claims in the first year. 15% will have minor defects, and 5% will require major defects in the first year. Macadjo estimates that in the second year of the warranty, 20% of the items sold will have minor defects and 10% will require major defects. All right. Sorry. Now, so we're giving this table, okay? So now I say we should do it. Okay, I think we're also giving, they said assume a discount rate of 4%. You know, when I told you earlier, when you are measuring provisions, we're going to discount to present if you are given actually. Okay, so what do we do here? Now, remember, their provisions are measured at the best estimate of expenditure required to settle the obligation. And we also said for a single item, the most likely amount payable, but for a large population of items, the expected value. So obviously, this is a large population of items because I've sold to so many customers and I'm expecting a number of them to probably bring the product back. So in that case, I will compute the expected value. So I'll do year one, which is my standard warranty. Remember, I did one question earlier, exercise one, if you can remember, when we look at how much was sold, how much is going to be returned, and the cost of repair. That's what we are doing here. But with a little bit of complication, but it's not really complicated like as such. Okay, so let's find out. So that's exactly what you do in provision. So he said in the first year, which is the standard year or the standard warranty period, he said 80% of the building will be subject to, will not be subject to warranty in the first year. Oh, okay, 80%. So that means it's going to be 80% of zero. Do you agree with me? So I mean, you know, I have 100%, so 100%, 80% will not return. That's what they are saying. 80% of zero. That's fine, right? Then it now says 15% will have minor defects. Okay, 15% will have minor defects. Oh, okay. So what does that mean? So I will come to my sales. I sold 2,000 under standard warranty, and I sold 5,000 under extended warranty. So what is this telling me? So I have a total of 7,000, right? I have a total of 7,000. So I sold 7,000. I expect, remember I'm in year one, okay? I sold to all of my customers, but some of them have extended warranty, but I'm still dealing with year one. So now say 15% we have minor defect. So I say 15% of 7,000 multiplied by 100 because that's the cost. Minor defect. That's what I'm doing. I have a figure. Can I press my calculator to see whether I'm going to get that? So 7,000 multiplied by 0.15 multiplied by 100. I have 105,000. So that's it. So I've done that. Then I move on. It says 5% will require major defect. Can you see? 5% will require major defect. I also say 5% of 7,000 multiplied by 500. So that's major defect. So, okay, so that's what you're doing. Okay, I'll now go to year two, which is the standard warranty. Now say Macadjo estimates that in the second year of warranty, 20% of the items sold will have minor defects. Okay. 20% of the items sold. 20%. So when I get to year two, what will be my sales? My sales will be 5,000 and not 7,000. You know, we use 7,000 in year one. When I get to year two, it's 5,000. Why? Why is it 5,000? Can you connect that? Remember, I sold to all the customers in year one, all of them, I sold 7,000. And I gave some of them, major customer, extended warranty. So if I have sold all in year one, I use 7,000 because both year one and extended warranty can return in year one. That's why we use 7,000. But when I get to year two, the people in year one that has just 1 year warranty cannot bring it in year two. It is only from the population I sold to in year two, that in year one, but that has extended warranty into year 2 that I can bring, which is 5,000. Under extended warranty. So I use 5,000 on 20%. Is it minor defect? Yes, I multiply by 100. Then 10% require major repair. So 10% of 5,000 multiplied by 500. And that's the end of that question. Let me show you. Can you see? So you are computing expected value. Then you discount whatever you have gotten in year 1 by 4%. Then in year 2 by 4% because that's giving me the interest rate. So this is the 80% of new that I talked about. 15%, can you see? Minor defects. Then 5% major defects. Can you see that? Then in the year 2, 20%, 5,000 minor defects, 10%, 5,000, 500 major defects. And that's it. So you can just read through to see all those computations. That takes us to the end of IAS37. Any concern for me? Successfully, we take a look at what's it called? The meaning of provision. I told you how entities can use provisions to manipulate accounts. And I also told you differences between contingent liabilities and contingent assets. Then we also took a look at the recognition, the measurement. I took you up on 5 scenarios of 5 issues around provisioning: future repairs to assets, future operating losses, onerous contracts, environmental provisions, and of course, restructuring provision. Okay, and that is the end. I want to believe you are more comfortable with that, so we can move on. Oh, I even have a drawing here. So this is a summary. Okay, that's fine. So you have the questions there that you can practice. If you are concerned, please let me know. So let me quickly explain IAS8. Okay. I'm going to explain IAS8. Accounting policies, changes in accounting estimates, and error. I'll just explain. I may not be able to take questions today, so I will not really bother you much. I know you are still trying to balance on IAS37. Obviously, we can't be taking one standard per class. At least let's do 1.5 standard. But I know in the next class, in 30 minutes, I finish it off. Then we can start something else. Okay. So let's look at IAS8. In the next, we have 28 more minutes. Okay. I may not use up to that minute. Once I want to get to calculation, I'll just stop. But let me see whether I can explain accounting policy, changes in accounting estimate, and errors. Okay. This is quite central to your syllabus, whether you're writing ACCA or ICAN. And for me, personally, this is the most technical standard. Okay. This is the most technical standard, not even financial instruments. Financial instruments just be many things to learn there. Okay, but there are certain areas that the examiner normally comes from. So I'm going to deal with that. Okay. But for me, this is the most technical standard. And most lecturer will not want to take you IAS8. They will just tell you, time has gone. But I'll take you. So let's see. IAS8. I would like to use a board marker to explain this. So I don't really want to rely on I don't want to be looking at the slides. I don't really like that. So I will be able to demonstrate more when I have a board marker. So you permit me, let me go to the boardroom. Is it the boardroom or the classroom where we can use the marker board? Then I can explain accounting policy properly. Okay, so I'm sure you are not sleeping, even the way I am. So I'm really feeling so sleepy, but I needed to do this. So let me see. I'm trying to find my marker. Okay, the marker is up. Okay, so IAS8. So I want to talk about accounting policy. Oh, sorry. Let me try to restart this so that I can write well. Sorry about that. Okay. Sorry. So I'm just trying to I'm looking for the marker to come on board. Okay. Okay, yeah. Okay, let me see if I can write better. Yeah, brilliant. IAS8. Yeah. Now, I'm dealing with accounting policy first. So I'm going to take you what is accounting policy. Okay. We're going to look at what is accounting policy. I'm going to take you on selection of accounting policy. Okay. Selection of accounting policy. Change in accounting policy. Okay. We'll look at change in accounting policy. Then when can I change? When am I permitted to change my accounting policy? Then recognizing, or let me say determining if there is a change, in accounting policy. Okay. And the last one I would like to take you here is accounting for a change in accounting policy. Okay. All right. So we'll be dealing with this under the accounting policy. So I still have accounting estimates and errors. That one will not take me 5-10 minutes. So let's see whether we can quickly do this. Okay. So that's why I actually like to come to the board so that I can really demonstrate this. Everything I'm saying here is in your notes, actually. Okay. So what's an accounting policy? Accounting policies are specific principles, conventions, bases, rules, and practices applied by an entity in preparing and presenting financial statements. There are specific principles, okay, rules, bases, conventions, and practices applied by an entity in presenting or in preparing and presenting financial statements. Nobody's going to ask you that at this level, but you need to know. Now, say for example, depreciate all non-current assets. So that is an accounting policy. But you might need to know that definition. You know, the way ACCA is structured, you need to respond. So you might need to start by defining on what accounting policy is. Okay? So depreciate all non-current assets. All non-current assets. Okay, so that is an accounting policy, or that's an example of accounting policy. Okay, so that's that. Now, so let me take a look at selection of accounting policy. Sometimes the examiner can call it basis of accounting policy. Okay, the guy can call it basis of accounting policy. Now, what does that mean? If an entity wants to select an accounting policy, what happens? You look at two things. Number one, is the area covered by an IFRS? For example, there's an event that occur in your company, or there's a transaction that occur, okay, or you have a scenario in an exam. For example, the examiner says in the area of depreciation or in the area of inventory, or you mention any item, advise the company on selection of accounting policy or factors to consider, or the basis of accounting policy. What do you tell the examiner? In any of those scenarios, what do you tell the examiner? You tell the examiner that according to IAS8, if the area is covered by an IFRS, then that particular IFRS should be applied to that transaction or event. So that's what you are telling the examiner. Okay, if the area is covered by an IFRS, then that particular IFRS or interpretation or standard should be applied. Sorry, should be applied. If the area, sorry, the area is covered by an IFRS. But if the area is not covered by an IFRS, so that means there are two things here. Okay, that's the explanation you are giving the examiner. It means there are two things. Let me try to see if I can do that for you. Okay, the first one is areas covered by an IFRS. Okay, areas covered by an IFRS, you apply that particular IFRS. Then the other option or that can happen is areas not covered by an IFRS. Okay, so if the area is not covered by an IFRS, IAS8 says the management of that entity should use its own judgment. Okay, you use your judgment in developing an accounting policy for that particular transaction or event. Okay, management should use its own judgment in developing an accounting policy for that particular transaction or event. So you use judgment in developing an accounting policy. Designer now says in developing that accounting policy, they must be reliable to decision making. They must reflect the economic substance of the transaction. They must be faithfully represented. They must be neutral. Is that okay? They must be prudent, okay, and complete in all material respect. Everything I'm saying is in your notes. Is that okay? Okay. And in doing that, they must also consider in descending order any IFRS or standard that has dealt with similar transaction before. Then they must also consider the recognition criteria, the definition of an asset, measurement of an asset or liability as contained in the conceptual framework. So when they are deciding or developing an accounting policy, they use their own judgment. Please take notes, okay? So when you see selection of accounting policy, or you see basis of accounting policy, just tell the examiner, if the area is covered by an IFRS, they apply that particular IFRS. Is that okay? If it's not covered by an IFRS, then the entity should develop an accounting policy by using its own judgment. Okay, so please take note of that. Please take note of that. Okay. Now, so we go to our time is moving. Let me, in fact, if I can explain all of this today, I'll be glad. Then next week, I'll explain the other two stuffs. Then we can solve our question. Now, change in accounting policy. Change in accounting policy. I cannot wake up one day and go and change my accounting policy. No way. Okay? Any of these three must happen before I can change my accounting policy. Number one, is it required by a statute? Okay? Is it required by a statute? That means, for example, in Nigeria, CAMA, okay? Or let's say Finance Act, okay? Finance Act in Nigeria. I'm talking about Nigeria, okay? You know, you're writing ACCA. So most likely, the ACCA we avoid this question, except for people in the UK, okay? Now, if it is required by statute, but if you're doing that, you can obviously say CAMA. Okay, so if it's required by statute, that is when I can change my policy. I cannot just change it anyhow. Okay. Number two, is it required by an IFRS? Maybe an IFRS has said I can change my policy. For example, under IAS23, you know, before, when you go to the bank to borrow money, the cost of borrowing, where do you take it to? Profit or loss account. You expense it. IAS23 now came on board. It now says part of that borrowing, that part of that cost of borrowing can be capitalized. Okay, it is required by an IFRS. So a classical example is IAS23 borrowing cost. If it is not required by an IFRS or by statute, I cannot change my policy. Then number three, if it will make the financial statement to be more relevant, to be more relevant and reliable. Okay, to be more relevant and reliable, then I can decide to change my policy. Now, in my thinking, I had problem with that number 3. I had problem. So that means if I think using cost model is no longer reliable, I can decide to use evaluation model. Even though at the back of my mind, I'm trying to make my gearing level to come down, because if I revalue upward, I take it through revaluation reserve within my equity, then my gearing will fall. So that's the issue. You see, if you understand accounting standard, you already know how it can be manipulated, but the standard allows it. But you know why it was allowed? Because IFRS is principles based. It's not a rules based accounting system. So that's why it says if you think it will make your financial statement be more reliable and relevant, then you can decide to change your accounting policy. Is that okay? All right, that's that. So we have successfully checked out policy, accounting policy. How do you select your accounting policy? Then when can you change your policy? You check statute, IFRS, or relevance. Okay. Then the last two are determining if there's a change in accounting policy. You have to be with me here. Please be with me here. How do I determine if there is a change in accounting policy? I will look out for 3 things, okay, for me to determine that there's a change in accounting policy. You can see a scenario question, and the examiner asks you to check whether there's a change in accounting policy. Number one, I will look at my recognition basis. Recognition, okay? Recognition criteria. Is my recognition criteria changing? If the answer is yes, it is a change in accounting policy. For example, I have interest, okay, or finance costs. I normally recognize this interest in my P or L account. Now, I'm moving it to my SFP, probably because it is required by IAS33. So my recognition is changing. That's a classical example of what's it called? Change in accounting policy. Number 2, measurement. Is my measurement basis changing, or measurement criteria? Is it changing? For example, I have PPE. I used to measure PPE using cost model. Okay. Now I'm changing to revaluation model. That is a change in accounting policy. You need to take note. My measurement basis is changing. It can also occur to inventory. I normally use LIFO method. Now I'm using FIFO method or an average cost method. Is that okay? Last in, first out, first in, first out. Okay, that is changing. That's measurement basis is changing. And the last one, presentation. Okay, if my presentation is changing, it is a change in accounting policy. Let's say, for example, I have depreciation, okay, depreciation charges. Before, I recognize depreciation within cost of sales. Now, I said it's no longer relevant and reliable. I want to start recognizing it within my admin expenses, okay? What is happening? My presentation is changing. That is a change in accounting policy. That is a change in accounting policy. If you see a scenario question and it's asking you to determine whether the policy has changed, you check out for 3 things. Is my recognition changing? Is my measurement changing? Or my presentation changing? Any of them. If any of them has changed, there's a change in accounting policy. Obviously, we're going to see questions to demonstrate all of this, okay? But you need to understand that. And the last aspect I will take you is accounting for a change in accounting policy. And after I've done that, I will release you for tonight. So next week, I'll just go straight to explain accounting estimates, errors. Then we'll look at 2, 3, 4 questions. Then we'll move away from that, okay? Maybe you can now do some other standards before we take on foreign subsidiary and of course, good cash flows. Okay, so that's that. So let me go to the last aspect. I will need to clean this board. Any concern for me? Let me give you some few seconds. We still have about 10 minutes left. Okay, any question for me here? That's why I left the slide and I came in to demonstrate this so that you understand better. Everything I've said is in the pack there. Okay, it's in your notes. Okay, so but I want to have that classroom experience, so that's why I've come here to demonstrate this. Okay, I think we are cool. There is no question, so I can clean the board while I do the accounting for a change. Sorry, accounting for a change in accounting policy. Sorry. So let's find out. Oh, what's my okay? So I'm still on IAS8. Okay. How do we accounting for a change in accounting policy? What does that really mean? My policy has changed. Then how do I account for it? Is that okay? So that's what we are dealing with. Okay. Since my handwriting is not straight, so let me quickly do like this. So it looks like a design. Okay. Now be with me here. This is the last lap this night. So my policy has changed. How do I change? So let's find out. Okay. A change in accounting policy, a change in accounting policy are accounted for retrospectively. Okay, so that's what you need to learn. A change in accounting policy are accounted for retrospectively. Okay, now how do I do that? So let me find out. Let me do this. Let me demonstrate that for you this year. Then I have last year. Okay, now listen. The policy has changed this year. So let's say this year is 2021. Then last year is 2020 account. So I'm paying my account for this year, 2021. The policy has changed. So what happened? Change the policy. Okay, change the policy. So this year, change the policy. Is that okay? You know, the policy is changing this year. For example, finance cost is changing, the presentation, recognition, or whatever is changing. All right. Now, the standard now says if you are changing this year, okay, now if you are changing this year, you now have to go back, okay, go back to last year and restate. Okay, you go back to last year's figure and restate. So now going back to last year's figure is what we call, retrospective adjusting. Okay, that's what we call retrospective adjusting. Why am I going to last year to restate? For comparability. Okay, comparability. So that I can compare, I don't know why that one closed. I can compare 2021's account to 2020. Because if I change the policy this year alone, I can't compare with last year because I don't have the same policy last year. Okay, so that's what we call retrospective adjusting. So you change the policy this year, you go back to last year and restate the account. Okay, why am I restating? For comparability. And I will release you this night. Please drink water on what we have done tonight. Any concern from me? Any concern from me? That's IAS8, right? it's technical. I agree it's technical, but it's not something that we cannot understand. At least I'm teaching it, so you can understand it as well. Okay, but the most critical part, in case that I feel if the examiner decides to test, is determining if there is a change in accounting policy and the accounting for a change in accounting policy. So that's what I think will come up at this level. Okay. Any concern, any question? I'm not even sure whether people are listening to me or everybody has slept. No question. Okay. No question for me. Okay, say something then. Let me know you listen to me, you understand. Nobody is talking. Hey. Oh, okay. Thank you. All right. Thank you. Thank you. Thank you. I just want to be sure we are not sleeping. All right. Thank you so much for your time. I don't want to bother you more. Should I do the other two? No. Don't let me bother you. Go and look at this properly so that when I explain, although it's quite straightforward, the other two have quite the change in accounting estimate. Just know the meaning of change in accounting estimate, examples, and how to account for it. That's all. The same thing with error. What's the meaning? You know the meaning? Okay, example of error and how to account for error. Is that okay? So that's it. So I can even quickly explain that. I can explain that. A change in accounting estimate is an adjustment in a kind amount of an asset or liability, okay, as a result of reassessing the economic benefits or obligation that are associated with that asset or liability. Is that okay? That's a change in accounting estimate. Examples of accounting estimates could be useful life of assets, fair value of assets, inventory obsolescence, bad debts, warranty provisions, and all of that. Those are the examples of change or an accounting estimate, actually. Then one other thing is depreciation pattern. Listen to me. Remember, when I told you the meaning of accounting policy, I said depreciate all non-current assets. That is an accounting policy. But the depreciation pattern or the method, am I using straight line method or do I want to use reducing balance method? It's an accounting estimate. You need to understand that. It's an accounting estimate. Is that okay? Because I need to estimate my depreciation charges on my assets. Okay? So that's it. How do I account for a change in accounting estimate? A change in accounting estimate is accounted for prospectively. Prospectively. So I change now, I do the estimate now, then I continue. Unlike policy, I change now, I go back to last year. Is that okay? And that's all. Then error, prior period error. From that word, prior period, last year. It could be last year, 2 years ago, 3 years ago. Okay? So prior period error are omissions or misstatements. Okay, omissions from or misstatements in the entity's financial statement as a result of misuse or failure to use some information that, if they are available at that time, we would have taken account of them, or we did not use them. Okay, so we actually made omissions or misstatements. Okay, what are the examples of prior period error? It could be effect of mathematical mistakes, oversight, fraud, error, misuse of accounting policy, or misapplication of accounting policy. Those are errors. Okay, so I'm preparing my account this year and I discovered that I made error last year. So obviously I will go back to last year and made an adjustment. So that means prior period error or error are accounted for retrospectively. Okay, they are accounted for retrospectively because I'm doing 2021's account, for example, and I realize I made an error in 2019. I go back to that account and I adjust. Even as far back as 5 years, it's possible. However, there's something we call impracticability. Say, for example, you made an error and it was 5 years ago, and you can't access that account again. Probably you change your, let's say, software 2 years ago or 3 years ago. You lost those data. Okay. The standard now says that's what we call impracticability. The standard says, IAS8 says, you go back as far as when it is practicable. If it is 3 years ago, just go back there. Once you correct that error, it will affect all the opening balances. Okay, so that's it. But as an argument, that IAS8 can lead to earnings management. Okay, that entities can use IAS8, especially on error, to go and manipulate their account, because they know that if you go back to last year and probably reduce something or increase something to affect the opening balance. Okay, so the effects of that error are not known in the current year. It doesn't affect the retained earnings in the current year. So that's an argument that entities can actually use it as earnings management. Okay, and that is that. So next class, by God's grace, I'll just try to solve some questions around that, so that we can move on. All these notes, I've tried to summarize this on that marker board, just one page. I'll do one on that page. Okay, all the notes, I've summarized it. Okay, there's a problem. It has been argued that the requirement of IAS8 to adjust prior period errors retrospect may lead to earnings management. Can you see that? By adjusting the prior period errors through the opening reserve, the impact is never known in the current period. I'm just preparing the current period, so I just go back, manipulate whatever I want to manipulate, then, I have the opening balance, then it doesn't affect anything in the current year. So it's an argument actually. So the next class, I'll just start from this question, then we try to see if we can solve them. Okay, so thank you for being with me. I really appreciate it. So I hope we are cool with IAS37 and we can show some flexing, some muscles around IAS8. So thank you for being with me. I will see you next week by God's grace. I want to wish you happy night rest and have a wonderful weekend ahead. Thank you for believing in me and thank you for staying tuned with me. Take care and have a wonderful night. Good night.